Hi, everybody. Good morning or good afternoon, depending on your time zone. We're glad you could join us today. We're just going to wait one more minute. I see some attendees are still trickling in, so we'll get started in just a few moments. Thank you very much for coming in. All right, so we'll go ahead and get started because we do have a lot to discuss. Thank you once again for attending and welcome to our latest webinar, SOFTRAX's latest webinar, The Future of Finance, A Practical Path to Continuous Accounting. So I'll just go ahead and I'll briefly speak about the agenda. This is actually going to be part one of a two-part webinar series. Today will just be an intro to continuous accounting as a concept, why it's important now, as well as some past approaches that companies have taken and why they ultimately failed. We'll also outline some ways that you can measure your own back office, see how you stack up and see what the technologies are available. And finally, we'll go ahead and outline a 5-phase practical process, how you can move forward towards back office automation. So our follow-up webinar in January, it'll be a few more concerns, a few more considerations about back office modernization, as well as the impacts and the skills necessary. But a few housekeeping things before we start. This is going to be a CPE eligible webinar. So for 50 minutes of attendance, and if you answer the 4 polling questions that will intermittently sprinkle throughout the presentation, you can earn 1 CPE credit. And as always, we encourage questions. If you have questions, you can go ahead and submit them in the GoToWebinar console's question box. Should be on the right of your screen. If we have time at the end of the presentation, we may or may not, because like I said, we do have a lot to discuss. We'll use any spare time for a Q&A. And if we don't have time to get to any questions that you answer, we'll follow up directly with you via email, or we can set up a call if you like. We'll make sure that your questions do all ultimately get answered. So I'll also speak really briefly and introduce today's presenters. My name is Ian. I'm a marketing manager here at SOFTRAX. My role is largely coordinating events and webinars such as this one, but at the same time, I'm frequently a first point of contact for executives looking for info about revenue recognition or renewal processing milestone billing. And for that reason, I hear a lot of common concerns, and for that reason, this webinar is very exciting to me. We also have Tom Zolli. He's our SVP and our general manager here at SOFTRAX. He's closely involved in a number of implementations of our software, and beyond that, he's had hundreds, if not thousands, of conversations with CFOs and CAOs regarding improving processing and back office automation. So he's really at the forefront of this entire movement. And to speak a little bit briefly about the company, SOFTRAX, we're a division of our parent company, AFS Technologies. Our focus has always been to deal with the most complex revenue recognition issues that companies face. So we have solutions for complex revenue recognition, complex billing, and renewal management. We're a global company alongside our parent company, AFS Technologies, and we've been in the industry for a long time now. We have 800 deployments, 0 failures, and we're on the 4th generation of our architecture. It's designed specifically to handle complex RevRec. So as for our clients, as you can see, we serve clients in a wide range of industries. Our goal is actually to address challenges across industries. We work to build solutions that can help companies of all sizes, of all industries across the gamut. We strive to grow with our clients, and there's a small sampling here. So as you can see, with that, I can turn it over to Tom Zolli, who will take us through continuous accounting.
Okay, thank you, Ian, and thank you everybody on the phone for joining the webinar. As Ian said, continuous accounting is a very complex topic, so let's just start with what it is. So continuous accounting, I'm sure many of you are familiar with it. The concept is to try to take the mundane and the grinding tasks out of the accounting process and really drive toward a state of either total or very near total automation, where the machine takes over and handles the processing, handles the reconciliations, and it frees humans to do the higher level work of financial analysis, reviewing reports, really becoming an ally to the CEO and the leaders of the business in terms of some of the decisions that have to get made. One of the things that I will say as part of speaking on this is that if you look at the type, at the base mathematics that are involved in the financial process, the money movements themselves, the various computations that occur, they are very similar to other types of mathematics that computers have always excelled at. So you're dealing with what could be simple operations, addition, subtraction, arithmetic, but that occurs in quantities of millions. And so compute power should be very well applied against this problem. Having said that, as we'll see in coming slides, it is not a simple problem to solve. So in terms of why automate now, I mean, there's a lot of reasons for it. I would say we sort of think of these in terms of the technology side of the equation and also the business side of the equation. On the technology side of the equation, certainly the advent of cloud computing and more precisely multi-tenant cloud computing, I think, has been very important. Also, from a technology perspective, there are also coming some very significant advancements that I don't think, if we look back 3-5 years, that they were readily available. So robotic process automation, blockchain, machine learning, artificial intelligence. I think that there is certainly plenty of hype out there about these technologies right now, but they are here, if not coming, from a very realistic perspective. The other thing that's happening is well, there are additional technologies to apply to the problem. The problem itself, in our opinion, is getting much more complex. Not necessarily for every instance, every company, not necessarily for every vertical, but certainly for many. I think that the internet, like we say here, is maturing. We're seeing far more complexity in how, at the highest level, how clients are monetizing their relationship with their customers. But certainly there's a strong migration to subscription billing. The complexity of those billing plans, as companies try to sort of right size the cost versus value of what they offer, is going up. It places heavy burdens on multiple areas of the back office, not just billing, but revenue recognition and certainly other areas. We also have massive regulatory change. So ASC 606, ASC 842, the statutory tax change that's going on, and plenty of other areas. ASC 606, we have a lot of conversations around it here at SOFTRAX because we are focused on revenue recognition. It was intended to simplify accounting. I can't say from any perspective that it has. I can certainly say from an operational perspective, it is created vast complexity, I think well beyond what we had in 605, which was, for some verticals, particularly the software vertical or technology vertical, was already complex enough. Additionally, there is a growing gap. And I think this is one of the important messages that we wanted to get across, because at some point, the back office becomes a competitive differentiator for companies. It could be there now. It could be at some point in the future. But certainly as leading companies start to heavily automate these processes, and some are doing it now, right? They gain a distinct competitive advantage, and there's we feel that there's definite risk in falling behind, and that's one of the reasons why we felt like this webinar was appropriate. The classic example of this that actually Steve Jobs used to cite all the time was the case of MCI Friends and Family, which, you had at that time, a fairly large company, but nothing compared to the size of something like an AT&T. And they introduced essentially a billing plan. And what was very interesting about that case study was that they actually took very significant market share from AT&T, not because AT&T couldn't replicate the plan. I mean, they could have done that, but the bottom line was that they couldn't move their back office forward fast enough to absorb the additional complexity of the Friends and Family plan. And that's despite having, a very substantial amount of, human and technology resource able to throw at the problem. So it sort of is a canary in the coal mine in terms of looking at some of these things. And with that, I think, Ian, we have a polling question.
Yep, I'll go ahead and I'll launch the first polling question. And that is, you should be able to see it now. How would you characterize your current level of automation in accounting and finance in your back office? So is that 100%? Is that 80% with some spreadsheets with some customizations? Would you say it's 50-50 or less than 50? So you can go ahead and vote. We'll keep it open for a minute here, just so everybody has a chance. All right, and it looks like just about everybody has voted, so I'll go ahead and close it up in a couple of seconds. Say 5, 4, 3, 2, 1. All right, thank you very much. And here we have the results. So, Tom, what do you think about that? Is that what you expected, or is that any thoughts?
Actually, I can't see the results because I have the presentation deck up. But could you just read them off to me? And
sure. So it looks like we have nobody answered that they were 100% automated. It looks like we have 21% of people saying that they're 80% automated with some spreadsheets and customizations. We have 44 people saying they're at 50-50, and 35% saying they're less than 50%.
I would say it's as expected. I mean, those are the results that we typically see out in the field. It is possible, but very hard to get to 100%. And I guess one pertinent observation that we've had is that with the advent of in our space, with 606 primarily, I mean, see it a little bit with 842, things like that, but there is certainly a broad category of companies, including public companies, that have stepped backwards a bit in automation as they've had to rapidly absorb the 606 and the 842 standards. I think we've got a few companies that have taken that as an opportunity to actually try to push forward in automation, but very difficult because they're simultaneously absorbing all that complexity.
Mm-hmm. All right, thank you very much. I'll go ahead and hide that, and we can keep moving forward.
Okay. We wanted to use a few minutes just to speak about past options and how they've worked and how they've failed, really. So the classic one, I mean, the go-to play in the 90s from our perspective, if you were a large company, you would buy one of the large ERP platforms. If you were a manufacturing company, I mean, ideally, they would support you out of the box. That was the vertical to which they were primarily designed. If you had complexity, and I know certainly in the technology vertical, there was plenty of this, you would typically have to do some level of integration. On the good side, in a situation like that, I mean, these were on-prem at the time too, so I said integration customizations were very possible. On the good side, I mean, you're dealing with a single platform vendor, less integration issues, although still some, obviously, if you have to integrate the homegrown systems and others. One throat to choke. On the downside, and I'll call it a downside and an upside, I mean, any modification that you needed to make to those systems, I mean, usually there was a way to do it through the customizations that would be done by either your system integrator or the professional services staff. And it was important because, if your business was changing, there was a way to go. The problem that occurred, I think the most fundamental problem that occurred with this option and would occur again today is as you start to increase customizations, you rapidly diminish your ability to upgrade that platform. And that has, as we ended up eventually seeing in the 90s, very, very bad consequences. The customizations prevented upgrades. The upgrades meant you were locked into a prior version. Bad for the vendor, bad for the back office company, because the vendor would end up getting forced into patches to that version. So instead of fixing the problem in one version of the application, they would have to fix it in potentially many versions, including some customized versions. It caused, an increase in staff. As we'll talk about in a minute, the customizations themselves, they tend to drive instability. It is catch-22. The best scenario is to have out of the box functionality that's actually tested via a very strong regression test or set of regression tests and other techniques by the vendor. In the case of customizations, that approach is probably unlikely. It's probably unlikely that the vendors are going to test your specific customizations in their QA shop. The benefit of customizations, to be frank, is that as long as your use profile is known, you can test them specifically for how the one company that uses those customizations is using them, which is you. So some trade-offs there, but at the end of the day, I think it's very problematic to try to subsist in a highly customized environment. It's just too much effort to move that environment forward as the business changes. And so we talked a little bit about the stability here. So as I say, it's hard to, and this comes up later in the deck, but it's hard in the concept of an on-prem application with heavy customization to maintain both stability in that application, but also the agility to push it forward. And I actually think that was in part the problem that AT&T had in catching up with MCI on the Friends and Family program. Another option is spreadsheets that we hear talked about a lot, and I think most people on the line know that Excel is an amazing tool in terms of the things you can do with it, including some fairly automated things. But B, it's not a good idea from like a security and controls perspective, controls on top of controls. The important point here, and this goes to any strategy that you take toward continuous automation, whenever you inject a spreadsheet or some other workaround process, particularly a process that involves humans in the loop, you essentially break your ability to reach continuous accounting, because the issue is as you add these spreadsheets, it's pain relief, right? Spreadsheets are like, I have something I have to get done. I can't systematize it right now. I'll kick it off to some manual spreadsheet. It comes up. There are times when you have to do it. Just do it knowing that the problem is it stays on those spreadsheets far too long. The classic, the prototype becomes the product essentially. So when you do that, just know that you need to get it back off of those spreadsheets if you're going to have a shot at high-level automation or continuous accounting, because those spreadsheets have ripple effects. The ripple effects are that it really diminishes your ability to do things like ensure synchronized data between systems, ensure any kind of automation of reconciliation between systems. So we'll talk about it in more detail in the second webinar we do on the topic, but so I will leave it there for now. And with that, I guess we go into our second polling question.
That's right. I will interject again. Our second question will be, is your core ERP platform running on-prem or in the cloud? So ERP is in the cloud with no customs. ERP is in the cloud and you're able to customize in the cloud. Your ERP is on-premises with no customs, or your ERP is on-premises with customizations. We'll leave it up another few seconds as those votes are trickling in. All right, looks like just about everyone has voted, so I'll go ahead and close it down in, say, 3, 2, 1. And for results, Tom, it looks like 7% say that they are in the cloud with no customs. About 40% say that they're in the cloud and they're able to customize in the cloud. We have 12% who are running ERP on premises with no customs and 40% on-prem with customizations.
Okay. I mean, those metrics make sense. The second option there, I guess the question would be, and maybe we have another question on this, but in the cloud, are they running single tenant or multi-tenant? And I will get into that in a little bit, the difference between the two. But everything else seems fairly standard. I mean, the net of it is, at least in this sample space, is that the majority of the people out there aren't able to run out of the box, but require customizations to get the job done, which is interesting, not unexpected, but interesting.
Mm-hmm. I'll go ahead and hide that poll. Thank you for that.
Okay. Yep. Thank you. I just want to spend a couple of minutes on just framing up, some metrics for the back office. Probably nothing new here. Obviously cost. I mean, we're all in finance, so cost is key. Certainly risk. I mean, these are the numbers that run the business, right? And companies that report to public markets, there's all kinds of risk to be avoided there. As part of that, making sure that there's strong security and controls, making sure that you have strong audit, transparency, usually via reporting. And you can see we bolded the last two, stability versus agility. So this is what makes this a hard problem, in my opinion. You want to drive as much automation as you can. I think everybody agrees. To do that, you have to build up infrastructure that can handle that automation. And it's not as easy as just creating some spreadsheet or something like that. And, there's work to be done. We've all been through those projects. At the same time, and this is where a lot of companies miss it, when you build up that infrastructure, it has to be done. It's a much easier task to do it to get automation in place. It's a much harder task to do it to get automation in place in a manner that will allow you to carry that automation forward. So, for example, if you acquire a new division, how long would it take you to onboard that division in a scenario where they have very different processing than what you have, as a classic example? Or if the business comes down with a brand new offering, maybe you've never had a subscription model before, and now they have some very complex subscription models that they want to start putting out there. The ability to not only obtain the automation, but to maintain the automation is the hard part, if you will. And we will talk about that a little bit going forward. Related to these metrics, so the question is frequently, if I'm going to invest in this, and it's not a trivial investment, what do I gain? And we put some metrics here, and these are high level numbers. But the reality is that you really should plan to gain a lot. If it's done right, I don't believe that this is a incremental improvement, if you will, to the back office if done right. I will say that most of the successful automation efforts that I've seen that have gone very well have been incremental. So it's not revolution, it is evolution. And we'll talk about options for various steps that you can take in a moment. But I do think that you need to have a plan. You need to make sure that each step that you take has standalone value, so that you're not waiting till an end state for the value, because that end state will likely never come in that scenario. But if you do that and you march, step by step, filling gaps, driving automation in a logical way, then I do think you can get to the holy grail of a 2-day close period, or possibly even less. I am aware of companies that are doing that today. Not a huge number, but there are some. There are some that have complex processing that are doing it today. The concept of automatic reconciliation, so that there is no reason, really, technologically speaking, there's no reason why you can't have continually running reconciliation and notification of just variances, whether it's variances between subsystems, variances within a subsystem. It's technically possible. It's not easy, but it is doable over time. And certainly as you pull out the work around spreadsheets, things like that, humans in the loop. Again, it's incremental, but you start to truly tighten up on the security and controls, such that really you have people going in only on an exception basis, and it's very well tracked. So. And we see at the bottom, which is another strong point. I don't think this problem can be solved strictly by technology. I don't think it can be solved strictly by finance. I do think it requires cooperation and collaboration between the two. And actually, in our second webinar, we have a section that speaks specifically around skill sets and where we see evolution to even the organizational structures within an organization. So a point that we wanted to make at this point in this presentation is that there's a very interesting parallel to what we're suggesting and what the whole concept of continuous accounting suggests. And probably it was never brought out better than in the case of the work that Alan Turing did on the Enigma machine, back in the days of World War II. And so the truly brilliant thing, among many things, that Alan Turing did was he very quickly recognized that in terms of decoding Enigma, and that decoding, by the way, is again nothing more than millions and millions of very simple mathematical operations that are simple in isolation, extremely complicated in aggregate. But he realized that there was no chance of them being successful with a human in the loop, with even one link in the chain of it being a manual process. And so he started very early to build out this machine, the ACE pilot machine, which eventually cracked the code. And this relates back to the initial discussion that we had regarding this growing gap between companies that are driving toward automation and those that aren't, because those that are driving toward, when they finally get to that last bit of taking the human out of the loop in some certain section, then the ability for them to handle volume, handle complexity, just free resources to do other things goes up literally exponentially. It's kind of a good analogy. And another thought before we get into the actual meat of it. It is one of my favorite photos. So the point here is that what we're going to describe in the next part of the deck is some of the complexity and some of the challenges of getting to continuous automation. It is a complicated problem, but we live in an era of solutions to very complicated problems. In this case, this is a photo of SpaceX launching and landing a rocket booster for the first time. This one happened to be returning the booster to a land-based site, but they obviously, as people are aware, they've been very successful in landing these things on a floating dock in the middle of the ocean, which is literally the size of a postage stamp when seen from space. So it's the challenge of continuous accounting is nothing compared to that challenge. So it's hopefully inspirational. And with that, we'll talk about steps that can be taken to start the approach. One comment, in these steps that we're about to present, there are plenty of companies in the Fortune 500, companies 20 billion and up, that build their own systems 100%. And so we're not really catering to them because it is truly a small set. They probably use a core ERP, but they just write a ton of code around it and build up their whatever they need that they don't have out of that core ERP. So we're gearing this toward companies probably, in the order of like maybe 20 billion and less, all the way down to very small companies. So first recommendation is have a plan, which I know sounds easy to say, but we all deal with organizational challenges and things like that. But the plan has to have really well-defined steps, and it has to, show value at each step. You have to gain executive buy-in, and it will not work without executive buy-in for reasons we'll get into. We've seen very few cases where you can do this in one step, one go. So, plan on multiple phases. And with that, I think we have one more question. Two more.
That's right. Polling question number 3. and that will be, are you running on a single platform, or do you have multiple applications running to address different needs for accounting and finance? Are you on a single platform with no point solutions, no spreadsheets, and no customizations? Do you have significant customizations? Do you leverage a significant number of applications? Do you leverage a significant number of spreadsheets? Or do you have a combination of spreadsheets, applications, and customizations? So I realize there's some overlap here, whichever one most accurately addresses your situation. All right, and it looks like just about everybody has voted. A couple more trickling in. So I'll go ahead and close in, say, 3, 2, 1. Thank you very much. And as far as results, Tom, we have 7% on a single platform with no point solutions, spreadsheets, or customs. 10% say they have significant customizations. 10% say they're leveraging a significant number of applications. 12% say they have a significant number of spreadsheets. And 62% say they're in a combination of spreadsheets, applications, and customizations.
All right, good. I mean, not surprising again, and really the number on A was what we were looking for there. So it's telling, and it matches our other data that it's hard to exist on a single application, and it's a good segue. So we're about to talk about that next.
All right, excellent. Thank you very much.
Yeah. So and we talked about this being a 5-phase approach. We're going to walk through the phases that we recommend right now. One of them that, and we are not an ERP vendor, by the way, so it may be odd for us to be showing this as the first step, but it's an important one. So we want to put it out there. I mean, there's certainly value in moving to the cloud if you are on-prem. One caution, I mentioned it earlier in the deck. Cloud is a very broad term right now. In our opinion, the migration to cloud should look specifically at multi-tenant cloud applications. So to give you the difference there, for those that aren't aware, I mean, in general, people associate a migration to the cloud with moving an application off of some internal data center to some third party that takes care of the platform and hosts it for you. In that world where it is out of your internal data centers, there are single tenant instances and multi-tenant. Single tenant effectively means that you're running on a dedicated piece of hardware provided by that cloud vendor, and it's just you. So, literally you can almost think of like forklifting your server from your data center, moving it to a different building that they own the power, they own the HVAC, all of that stuff, and they run it for you. And in single tenant cloud, critically, you can have customizations because you are running on your own hardware essentially. In multi-tenant, you can think of it as a farm of servers of which you are one instance, and so to all those servers get deployed the same bits of the application. There are some companies that can still do some level of customization in a multi-tenant cloud, and it's a good question to ask if you're trying to understand that, because it would also be a question to ask, what is the test process then related to those customizations? Is that on you or is it on the cloud vendor? In general, and this is true for not just software, but many things in life, the more people that are running on the same bits, the more likely it is that platform will be stable over time. This occurred, and I don't know if many people probably won't remember this, but Wall Street in New York ran primarily on mainframes for a very long time, and then there was a tremendous battle when the workstations came out. Sun, HP, IBM. Sun won that battle through sheer numbers, because at some point all of the people in the IT shops that were buying this equipment realized that Sun, I think it was particularly the Solaris operating system, there were so many instances of it out there. When they came out with a new upgrade, within months it became super stable, very risk-free, because so many people were running the exact same bits. same issue here. So when you're looking at applications, whether they be point solutions or whatever, is it single tenant or is it multi-tenant? If it's multi-tenant, most likely it's the same bits, which also means the platform provider is testing the automated progression, etc. If the back office is simple enough, and in our last question, that's why that question was there. So for 7% of you, it's simple enough where you could find, albeit maybe a sophisticated ERP system, and you could be done. I mean, you could be very close to reaching a continuous automation, or continuous accounting approach. And so that's a question you have to ask. And if for the rest of this, we're going to assume that's not the case because, as you saw in the stat, most for the majority, it is not the case. So for those of you where it is not the case, or in general, you have to make the decision. Can you get by with a let's say a very sophisticated ERP platform with some customizations, but ideally not a huge number? And if you can, there are advantages to doing that. Again, one throat to choke, less integration issues, etc. If you can't, then when you're looking at the ERP platform sort of as a phase one, the question is, am I buying something that I'm going to use as a backbone? And I'm going to go with purpose-built solutions to handle those areas of my business that are complex, and potentially areas in the future that could be complex. Or am I going to go with something very sophisticated and just sort of locally augment with point solutions? If you feel like you have a lot of complexity in a lot of areas of the business, it may make sense for you to get a very inexpensive or less sophisticated ERP system and use it for core AP, AR, GL, and then take the time to surround it with point solutions, basically. So phase one is basically making that decision. The only other caveat we would have is that even if you go with a single platform today, if you're the type of company that's contemplating M&A activity, or other future changes, maybe heavy growth, then at minimum, we would suggest that you be prepared so that you could augment with a point solution rapidly if you had to, as part of your evolution to effectively to avoid the friends and family type situation we explained before. This part is probably the most important part or concept in sort of the early phases of a continuous accounting approach, and we do see companies struggle with this one. So a lot of people will come to us and they'll say, we have these gaps, we're currently solving them through manual processes, or they won't even consider them a gap. They'll just be manual processes that exist in a data flow right from when orders come in through collection of cash and all the AR type activities, or on the recognition side, the recognition of revenue. So there's a temptation to say we can't automate these because they involve X, Y, and Z, name your complexity. I've talked to thousands of people, CFOs, more likely CAOs on this. The critical thing is to identify the area of the gap and to try to articulate what is now occurring manually in the form of a policy. So that policy could be anything. It varies place to place. Sometimes billing should go this way. If it's this situation, it should go this other way if it's this situation. And the question is, what is that situation? What drives it? And when you do this articulation against policy, I mean, it can just be sort of mapping it out on paper. You don't have to worry about technology at this point. But the other important part of this is, literally at the field level, what data is required to make that decision or to support that policy. If you can do those two steps, articulate the policies and understand the field level data definitions, then you've just done the first step at filling that gap. The second step is to go out and search for some solution that automates it, ideally out of the box. I know in many cases it may seem like it's not possible, but there are so many billing vendors and AR vendors and RevRec vendors out there that you should be able to find one. And so step one is really understand the major gaps. Can you articulate any manual processes that are occurring as a policy? And can you find somebody that provides automation or support for that policy out of the box, keeping in mind the field definition? So that's what we would recommend as phase two. Phase three is an important one. And so what you're doing in phase two is basically trying to make sure that you can automate within each functional area. Those functional areas at some point have to talk to each other in an automated way. Phase three is about that interchange. Could be done in conjunction with phase two. It often is, actually. From our perspective, the most important thing to do is embrace some level of you could call it middleware technology, you could call it an integration layer technology. In our case, we call it a workflow technology. But the bottom line is, if you cannot get by on a single ERP, then you are going to have to send data between systems. When you have to send data between systems, even if you can do it today as a hedge, you should think about either a middleware layer or, like I say, a workflow layer for lots of reasons, as stated here. I mean, one, if the vendor is strong, and I'm talking to the point solution vendor, they will already recommend one, and they should have already built out a lot of support for integration within that layer. Typically all the vendors support APIs, potentially even hundreds of APIs. In our opinion, the layer is still important because, first of all, those APIs have to be called. There's a lot of administrative work that the IT guys deal with in terms of retries when they call APIs, error handling when they call APIs. What happens if, for example, the call fails? Maybe there's a missing data field on the incoming stuff and the downstream system can't handle it, right? That all has to be dealt with, but a lot of that can be productized. The second issue you have to deal with, and this is important because absent an ability to deal with it via a layer like this, what happens? It goes to some spreadsheet, right, which breaks the ability to get to continuous accounting. So this is all about risk mitigation to ensure that you have a path so that, yes, you may have to go to a spreadsheet in the near term while you get things taken care of, but that you have a path to get it back off that spreadsheet. So, for example, an upstream system is trying to communicate with, let's say it's a order entry system, or order entry system trying to communicate with a revenue recognition system, and the order entry system has data X, Y, Z, but the revenue recognition system really requires like a percent completion metric, right? Well, this integration layer, this middle layer, could be where a ideally lightweight transformation occurs. It takes, let's say, it's services, and it takes cumulative hours that are stored upstream and the hours spent to date and converts it into a cumulative percent of completion metric that the downstream system is expecting. I mean, as an example, but bottom line is, it's likely you will have to, at some point, do some of these transformations between these applications. So you just need to have an approach there. And we felt like it was important enough to call it out as a separate phase. When you have these two phases done, ideally, and by the way, we're calling them phases. There could be many steps. So you could attack billing today, subscription billing tomorrow, RevRec the next day, and then put the integration in like we're describing. But as you're attacking these two things, now you should have a path to start getting more and more confident. Okay, I can automate within the functional area, and I can also, without having humans in the loop or manual processes, I can automate between functional areas. That is the goal up through phase three. When you get that far, I think you're doing very well. I do think there is a role for RPA, robotic process automation. It's a buzzword, and it's one form of a technology principle. But if you've got the data flowing correctly and in the systems correctly, I think RPA can be very useful in terms of now dealing with data between systems. Not the flow of data, which is covered through the integration layer, but I want to reconcile between these two systems, or I want to reconcile between a particular, subsystem within my back office and some third-party system. RPA is proving, in the real world, to be very good at things like that. My caution with RPA is that, like any new technology, it's getting very hyped and it's getting described to do things that it's both not intended to do and not good at doing. And so one of the last things that you want to do is put a lot of complex logic within an RPA strategy. You lose things when you do that. For example, the ability to audit and some of the security and controls. Not necessarily, but you should at least keep your eye on those things. And so, for phase 4, once you get that far, we recommend looking at RPA. And we do not provide RPA, by the way. We just think it is the right technology to assist. So phase 5, and I will say I'm not aware personally of a company that is doing anything more than dabbling at this point. But phase 5 would be AI. And why do we add that here? So our experience has been that companies that have gone through phases, even just up to phase 3, without counting, even factoring in phase 4, we've seen a lot of success at getting both high automation and penny level accuracy in all of the accounting processes with one Achilles heel. And it's a common one, the entire idea of garbage in and garbage out. So the problem up through phases, even up through phase 4, is that automation will be perfectly accurate if the input data is perfectly accurate. There's no chance that it would understand if somebody misentered something and it could be a decimal point off. So an order of magnitude change, there's little chance that it's going to detect that. That's where AI could come in. So AI could be a great solution to one of the remaining Achilles heels of a continuous automation strategy, from the point of view of, how do I sort of keep tabs on the data that's coming to my system, which could be coming from third parties, it could be coming from people manually entered things, could be coming from wherever. And AI is pretty good at, over time, pattern recognition, even complex pattern recognition. So, it could solve that issue. And then there are other advantages of AI, certainly, basically anything related to pattern recognition or the kinds of things that either neural nets or machine learning are good at. So, like I say, we add it to this as phase 5. I think a lot of people that we talk to now, even the ones that are pretty far ahead, are really dealing in phases 2, 3, and a little bit in phase 4. Not seen a lot in phase 5 yet, but so the summary here, and then we can get on to the 4th question, is start with a plan. Consider changing ERP is very difficult. You don't necessarily have to do it. You could even stick with your on-prem ERP. If you've got a lot of customizations, you've got to assess, can I live with these customizations? And if my business changes, is it going to be super painful for me to move these things forward? Am I on a current version or am I way back? If you're way back, in the world of cloud, being way back on versions no longer really should be required in the world of cloud, especially multi-tenant cloud. And then, work through the plan. Figure out the gaps, seek out technologies that can automate within the functional area, come up with a plan to handle data flow between functional areas that's resilient to change. And if you get that far, you've already gone very far, then you can think about RPA and even machine learning. And with that, Ian, I believe, yep.
That is right. So it looks like our 4th polling question is going to be, which of the following is your company most seriously considering to use or already using to automate finance and accounting processes? So is that RPA, robotic process automation? Is that artificial intelligence? Is that blockchain? Or is that none of the above? All right, looks like those votes are coming in. So we'll leave it for another couple of seconds. We'll say 3, 2, 1, and we'll close. And as for results, it looks like 34% are most seriously considering RPA. It looks like 17% are most seriously considering artificial intelligence. It looks like 5% are most seriously considering blockchain, and 44% answered none of the above.
It's interesting. I mean, the matches expectation in the sense that blockchain in the context of corporate back office, I'm not so sure. I mean, it's a distributed ledger, so I would agree that I don't know that it's that applicable. Maybe in extremely large organizations. AI, like we said, it's AI. Even neural nets, which is one of the most advanced forms of AI, have been around since early 90s, if not late 80s. It's been around a while, but in terms of actual practical application, fairly new. Fairly new. I mean, you hear about it in self-driving cars and everything because that's all the rage these days. But in the back office, I have not seen a lot. And then RPA, it's a more accessible technology. I think one point I would make is that, and I should have clarified in the 5 phases, you do not have to do 100% of phase 2 before moving on to phase 3. And the same in the move from phase 3 to phase 4. That part is business specific. So if you have a couple of areas that are highly automated, you could even go right to RPA across those 2 areas, knowing that you still have gaps to fill in other parts of the organization. So I don't see any reason why it needs to be restrictive in that way, or I have not seen any in the field either.
And yeah. All right, so I'll go ahead and hide that.
So that's the conclusion of this portion of the webinar. It was a high-level overview. In part 2, we're going to drill into specific areas. I think there are important areas, and I think actually some of the harder things are not even just acquiring the technology and implementing it to drive automation. There's a lot that certainly we've learned and that we think is important regarding where does accountability sit in the organization, what are the types of skill sets that are required to support this strategy, just the organizational structure itself, are changes required there, and those are some of the topics that we plan to cover in the second webinar on this in January. If you have suggestions or areas that you're very interested in, please forward them to us, because we'll consider them either for that webinar or potentially a third that we hold at a later date. I think with that, Ian, we're wrapped, right?
I think so. It looks like we have a little bit of time for questions, Tom. We have a couple coming in. I don't know if you want to do that now or if you want to wait and just answer those individually.
No, let's take at least a couple of them. We have 7 minutes.
All right, great. The first question I'm looking at that's kind of interesting is somebody is asking about the implications towards their personnel as far as back office modernization automation goes. And I think that might be something that you're going to touch on in the second part of the webinar.
I am, but I mean, I can speak a little bit to it now. I mean, I think that I think that the automation is an opportunity, and I think that finance in general has an opportunity to really partner up with the lines of business, either the CEO or the heads of the lines of business. Those guys need clarity in terms of they're making tough decisions every day. Do they invest more in marketing and sales, whatever? All those decisions are based on numbers. All those numbers typically come through, multiple places, but certainly heavily impacted by the finance organization. So one, in the automation, I think you move resources to providing that line of value support to the lines of business. Then two, certainly, if you don't have a good, I call them an automation person, but somebody, they could be IT, it potentially could be a business analyst. There's a growing skill set around, getting these solutions implemented, being able to handle the integrations between the solutions, creating sometimes custom reports, managing the RPA. So it's a technical role for sure, various forms. I believe that the investment, even in just one of those, is returned 300% very quickly, in terms of pulling other work out of the process. So those would be my initial comments there.
Excellent. Thank you very much. Then it looks like we have a couple of seconds left. If anybody else has any questions, you can feel free to just drop them in the question box right now. Looks like we have time for probably one more good answer.
If anybody would like the slides to this, I noticed there was a question to send over the slides. We just, if you reach out to us, we will certainly share the slides with you. Okay. Oh. I see a question just came in, Ian.
Looks that way. Looks like what kind of RPA solutions are available for a typical ERP is the question.
No, that's probably unfortunately a very long answer. The best applications of RPA I think I've seen so far have not been within the ERP necessarily. It's been a case where you have a core ERP, you have other systems that are running surrounding that ERP, call them point solutions or whatever, or even other systems that are third party to you, meaning not in your particular house, and there are issues of access and all the other stuff you have to deal with. But those are the best applications. As far as the vendors that provide those solutions, the big four accounting firms right now, while they're not the technology producers, they are all developing major practices around future of finance in general, RPA specifically. So they could be a source of guidance and help you kind of even interact with the technology providers for RPA. We do not sell RPA ourselves. We interact with it from time to time, but in terms of actually acquiring a solution, we would be recommending off to probably one of our partners. So.
All right. Thank you, Tom.
It looks like that's the last question, Ian, so I think we probably can wrap up.
Yeah, it looks like that concludes it. So thank you, everybody, once again for your time. We're happy to have you. We're glad you joined us. And we hope that you would like to participate January 16th for part 2.
Thanks, everybody.